Tien the Mindful Investor, Mastering Emotional Regulation in Financial Markets, by Booksmart Club. Introduction. Investing is as much about psychology as it is about numbers. While traditional finance focuses on data and analysis, neurofinance reveals how emotions drive decisions, often leading to costly mistakes. This book explores emotional regulation techniques, neuroscience-backed strategies, and mindfulness practices to help investors stay disciplined, avoid panic selling, and achieve long-term success. Whether you're a beginner or a seasoned trader, understanding your brain's role in investing can transform your results. Let's dive in. Chapter 1. The Brain on Money: How Neuroscience Explains Investing. The Two Systems of Decision-Making, Daniel Kahneman's System 1, fast, emotional, versus System 2, slow, logical. Key brain regions in investing: amygdala, fear and greed responses; prefrontal cortex, rational decision-making; dopamine and loss aversion, why losses hurt more than gains. Case study: how panic selling during a market crash is a biological reaction. Chapter 2. The Psychology of Market Cycles, why investors lose control; emotional triggers in bull and bear markets; herd mentality and social proof, why people follow trends blindly; confirmation bias, ignoring red flags because of overconfidence; the role of media in amplifying fear and greed. Chapter 3. Emotional biases that destroy portfolios. Loss aversion, holding losers too long, selling winners too early; overconfidence and illusion of control, overtrading, ignoring risks; recency bias, assuming recent trends will continue forever; anchoring, fixing on past prices instead of current reality. Chapter 4. Neurofinance, how your brain reacts to gains and losses; dopamine and the high of winning trades; cortisol and the stress of market volatility; how stress impairs financial judgment; brain scans of traders under pressure, real studies. Chapter 5. Mindfulness and Investing, Training the Brain for Discipline. What is mindfulness-based investing? Breathing techniques to reduce impulsive trading; journaling to track emotional triggers; the 10-second rule before making any trade. Chapter 6. Biofeedback and Technology for Emotional Control. Wearables that track stress levels, HRV, GSR; AI tools that detect emotional trading patterns; apps for mental resilience, Headspace, Muse, etc. Chapter 7. The Habits of Emotionally Intelligent Investors. Warren Buffett's Be Fearful When Others Are Greedy rule; Ray Dalio's meditation routine for decision-making; how top traders use checklists to avoid mistakes. Chapter 8. Case Studies, When Psychology Made or Broke Investors. Bitcoin Bubble, 2017 and 2021, FOMO and Crash Psychology; GameStop Short Squeeze, How Reddit Manipulated Emotions; the 2008 Financial Crisis, Panic versus Opportunity. Chapter 9. Building a Personalized Emotional Regulation Plan. Step 1. Identify your triggers: fear, greed, impatience. Step 2. Create predefined rules: stop loss, position sizing. Step 3. Daily mental exercises: meditation, visualization. Step 4. Review and adjust: monthly performance audits. Chapter 10. The Future of Investing: AI, Neuroscience and Emotional Mastery. Will AI replace human emotions in trading? Neurofeedback training for traders. The Next Frontier: Brain-Computer Interfaces, BCIs, in finance. Conclusion. The Psychology of Sustainable Investing, Mastering the Inner Game of Wealth Creation. The journey through investment psychology we've undertaken reveals a fundamental truth: financial markets are mirrors of human nature. As we've explored from neural pathways to behavioral patterns, successful investing ultimately depends less on predicting markets and more on understanding ourselves. This conclusion synthesizes our key findings into an actionable framework for psychological mastery in investing. The neurobiological foundation of investor behavior. Our exploration began with the brain's hardwired responses to financial stimuli. The amygdala's fear responses and dopamine-driven reward-seeking create biological imperatives that often contradict rational investing. Modern neuroscience confirms what legendary investors have long practiced, that emotional regulation isn't just helpful but essential for market success. Studies from neurofinance labs show that experienced investors demonstrate significantly different brain activity during market stress compared to novices, particularly in prefrontal cortex engagement. The mindfulness revolution in finance. The integration of mindfulness practices into investment strategies represents perhaps the most significant evolution in modern portfolio management. Beyond simple meditation, we've seen how structured awareness training can create cognitive space between stimulus and response, improve pattern recognition in market data, reduce the physiological impact of financial stress, enhance metacognition, thinking about thinking in decision-making. Behavioral technology, the new frontier, the emergence of biofeedback tools and AI-driven emotional analytics has created unprecedented opportunities for self-awareness. From heart rate variability monitors to voice stress analysis software, investors now have objective measures of their psychological state during trading. This technological augmentation of emotional intelligence marks a new era where 1. Physiological responses can be quantified and managed. 2. Decision-making patterns become visible through data. 3. Personalized interventions can be precisely timed. Case study synthesis, patterns of success and failure. Examining our case studies reveals consistent psychological themes across market cycles. Successful investors maintained emotional equilibrium during extremes. Failed strategies typically showed cognitive rigidity and emotional reactivity. The most damaging behaviors consistently involved overconfidence during bubbles, myopic loss aversion during corrections, narrative-driven investing during transitions. The emotional regulation framework. Building on our findings, investors should implement a structured approach to psychological management. First, pre-trade preparation, environmental control, removing distractions. Physiological baseline establishment, intent setting for the session. Second, decision-making protocols, systematic checklists to override bias, time delay mechanisms for significant moves. Predefined risk parameters. 3. Post-trade analysis, emotional state journaling, process versus outcome evaluation, stress pattern identification. The future of psychological investing. As we look ahead, 3 developments will shape investment psychology. 1. AI-augmented emotional intelligence. Machine learning systems that learn individual behavioral patterns and provide real-time interventions. 2. Neuroadaptive interfaces, BCIs that adjust information presentation based on cognitive load. 3. Personalized behavioral finance. DNA-based risk propensity assessments and customized training programs. Final implementation checklist. To operationalize these insights, investors should complete a behavioral audit of past decisions, establish daily mindfulness rituals, implement at least one biofeedback tool, create an emotional circuit breaker system, schedule regular psychological performance reviews. The mindful investor of the future won't just analyze balance sheets, but will master their internal landscape. As markets grow increasingly efficient and interconnected, the final competitive advantage lies within our own psychology. By marrying ancient wisdom with modern neuroscience and technology, we can transform investing from a stress-inducing gamble to a purposeful practice of self-mastery and wealth creation. Remember, the investor's chief problem, and even his worst enemy, is likely to be himself. Benjamin Graham. Final thought: the stock market is a device for transferring money from the impatient to the patient. Warren Buffett, by Booksmart Club.